Good evening, everyone. Thank you for joining us today for our 2021 Market Outlook. My name is Kim Heffernan, and I'm here with Justin Valadez, and we are from Northwest Financial Advisors, which is a wholly owned subsidiary of Northwest Federal Credit Union. Today, we will be sharing research done with our broker-dealer, which is LPL Financial. 2020 was an unusual year, to say the least, in the markets, the economy, political climate. That really changed the way that we do business and connect. So we are going to go through our market outlooks as well as economy and post-election environment and look at the new challenges that we may be facing and how we anticipate to move forward through 2021 and beyond. So before we get started, there is a copy of this slideshow under the handouts section in your dashboard if you'd like to download a copy of those. We also have a troubleshooting guide if you're having any trouble seeing the slides or with the audio. We're going to go through the slides and then open up to questions after that. Questions can either be emailed to me throughout the presentation. My email address will be in the chat box for reference, and we'll also have it up at the end. We will also take questions verbally. If you have access to a microphone, you have the ability to raise your hand and unmute your profile. Before we get started, please note that the information in this presentation is for educational purposes only. It's not intended to be a substitute for specific individualized advice. We do recommend that you consult with your financial advisor for guidance specific to your unique situation. Please also note that this presentation is being recorded for the purpose of sharing the content after the webinar. All attendee questions will be removed from the recording before it is distributed or posted or anything like that. Now I will turn it over to Justin to kick us off.
Good evening, everyone. My name is Justin Valadez. I'm an advisor with Northwest Financial Advisors, and thank you for spending some time with us during your cocktail hour this evening. So I'm going to go over economy and the bonds outlook, and we're going to start with the economy. And if we can think about what seems like 10 years ago, before the pandemic, the economy was great, right? We were in the longest ever economic expansion, and then when the pandemic hit, we kind of turned the off button on the economy and closed things down, which caused us to go into recession. So if we could go to the next slide. This goes over previous economic expansions. And as I just said, from 2009 through early last year, we were in an expansion. And that was ended by the pandemic. And it's consensus among Wall Street that we have actually already exited recession. We won't know until later this year, but we entered the quickest recession ever, and we exited equally as fast. So we're in the beginning of another economic expansion, and this slide just shows compared to previous expansions, the average is 5.3 years, and we're only a few months into this. So with that, we'll anticipate a few more years of growth and continue to monitor things. So this is, we did a lot of webinars for our clients during the pandemic last year. I believe we were doing them about every 2 weeks. And we talked about, once we were closing things down, what does a recovery look like? And the K-shaped recovery came up a lot. This shows the differences for the job market last year. And if we think about, well, Wall Street actually did pretty well. And some companies did really, really well. Some didn't fare so good. High wage unemployment rates went down considerably. So if we think about companies that we now all know about, the Zooms and the Netflixes and the companies that everyone went to when they had to start working remotely and suddenly couldn't travel and leave, those companies were hiring people. And those companies were often technology or growth companies, and they have higher wages. Those who were affected most were probably the ones who could least afford it. So low wage unemployment actually rose considerably last year if we think about those jobs may be linked to the travel industry. So it's our hope that this year, as we get through a new normal, maybe midway through this year, that low wage unemployment rate comes back down as we begin to fully reopen things. So the economic forecast for GDP growth, real GDP growth, the continued response to COVID-19 is, including further stimulus, will be the key to sustaining the recovery. We expect some of the accelerated innovation that came with COVID-19 to have a long-term impact. If we think about, people were worried about how productive can we be working from home, and actually for most industries, people are just as or more productive working from home. So what types of those are here to stay? What does the office environment look like? As the pandemic subsides and restrictions are lifted, we will return to a new normal, and the pace of recovery should pick up speed when things fully open up. We expect this to occur midway through this year, which will fuel an above average GDP growth. So if we look at 2019, we had a great year in GDP growth for that year for the U.S., for a developed country. In 2020, obviously things didn't go that well with the pandemic, and then it's our thought that we will have a much better year this year than last as we finally reopen. We expect emerging market economies to lead the global rebound. It's an area that we like in the stock and bond market. And you'll see there, they typically have a larger GDP growth as these are developing countries, places like India that have a rising middle class. So they're expected to grow this year at about 5 to 5.5%. And we expect developed ex-US, which is Europe, Australia, Japan, to have a little bit more tempered growth, but still a positive GDP for them. Europe was a little bit more affected by the pandemic than we were, given their age demographic, and you add all the complications they've had over the last 12 years between recovering from the financial crisis and then Brexit, which they can't really seem to figure out how they're going to move forward. So we think have tempered expectations there, but think above average GDP growth in all three. To touch on inflation, it's a question we're getting a lot. Down the road at the Treasury, they are printing a lot of money, and so if we think about inflation over the last 10 years, really since the financial crisis, the Fed wants inflation at 2%. That is their target growth each year, and we've been consistently below that. And last year, of course, interest rates went down, inflation dropped. So the Fed has actually come out and said that they're going to let inflation get higher than 2% to make sure that the average over the last 10 or 12 years equals around 2% before they start raising rates. So we don't want inflation that's too high. Think about it like the Goldilocks scenario, right? We don't want inflation to be too high, and the way we combat that is by raising rates. So the Fed has come out and said that they're going to let inflation run higher than they normally would before they start raising rates, which leads us to think that over the next 12 to 18 months, depending on the speed of recovery, that interest rates are going to remain lower, and inflation may run a little bit higher, but 1.9%, certainly nothing outrageous. And unemployment, as we continue to open up, or do we stay in lockdown longer? What does that look like? Hopefully we're opened up by midway through this year and people can start getting back to work, and certain industries can start to come back. Bonds. So the economy kicking back into gear should provide a tailwind for stocks. The story isn't the same for investment grade bonds. There's still reasons to own them. An improving economy generally leads to higher interest rates. And when interest rates go up, current bond prices go down, which weighs on their yield or return. So while there's still opportunities for bonds in 2021, we want to be selective in where we go within the bond and stock market, which Kim will cover in a little bit. And we need to look out for the inflationary pressures down the road in the bond market. This chart goes over large declines in U.S. Treasury yields and how they have performed after declines. So the forecasted path of the 10-year Treasury yield provides a baseline for the way we view fixed income. LPL is targeting a 10-year Treasury of 1.25 to 1.75 by the year end, which is going to be helped by the economic recovery. And if we see over the last, since 1990, when we have meaningful drops in the 10-year Treasury, and you'll see each of those, the peak to trough in a fairly short period of time, it's happened 6 times. And since then, in all 6 cases, the Treasury yields were higher a year later by about 0.9% and 18 months later by about 1.1%. So it's something we want to keep an eye on and watch Treasury yields, because that can influence the overall bond market. This slide just goes over, and I'll just focus on the last line here, that the February 19, 2020, it compares returns, or negative returns in this case, of the S&P, and how did, it's going to use the Barclays Aggregate Bond Index, which is U.S. bonds, U.S. investment grade bonds. How did they compare during times of volatility? So we see there February 19th, last year through the peak of the downturn, March 23rd, the S&P 500 was down, we'll call it 34%. The Barclays aggregate was only down 0.9%, and treasuries were actually up. So there is a reason to own bonds. Even though we're not going to get equity-like returns from bonds, we own them to balance the volatility out in our portfolio, specifically if we're getting close to the point where we're going to need to start pulling money and living off of our investments, right? So if we're pulling money from our investments each month, maybe we look at using some of the bonds as our income until equities stabilize a little bit in times of volatility. So it's an important piece to own, just because interest rates will likely go up longer term, although we've been saying that for the last 11 years, and interest rates haven't moved too crazy upward. It's an important reason to own bonds, and there's a lot of places that you can go that can help negate the effect of the increase in interest rates in the bond market. And so with that, I'll turn things over to Kim.
Thanks, Justin. So I'm going to start off with policy. Looking at the political side, we're really on a new course. So with the Georgia Senate elections that were held earlier this month, the Democrats will control both chambers of Congress along with the presidency. This has created a blue wave, if you will, which isn't the perfect outcome for investors, but historically, as we can see here, it has not been bad for stocks. So this is the S&P 500 performance during Democratic control back to 1951. So the index overall has finished higher, positively, ending the year positively, 6 of the past 7 times that we've been under this scenario, which goes back to 1978, with the only negative being very slight, down 1.5% in 1994. So since the majority that the Democrats hold is small in both the House and the Senate, this does create some gridlock, which is not necessarily a bad thing. It becomes limited to what can be agreed upon and may make some of the major reforms and the major disruptions that the markets were worried about in September, kind of take them off the table. This is like huge tax increases, breakup of big tech, things like that. So It's not something that we are overly concerned about, but of course are monitoring as we move forward through this transition. So on the equity side, with stocks for 2021, our overall outlook is that an earnings rebound may spark gains. As Justin mentioned, 2020 may be one of the most difficult years that we've ever experienced. We saw the worst pandemic in 100 years, the fastest bear market ever with a deep recession, along with all of the election uncertainty. But 2020 was a good year for stocks. So really, what are we looking at moving forward? Before we do that, we're going to look backwards. In 2020, as Justin mentioned, the S&P 500's lowest point was down 34%. We ended the year up 16. So for the first time ever, stocks produced a double-digit gain in the same calendar year after being down by more than 30%. We wanted to take some time to really reflect on how crazy of a year it was. These are the forecasts that we were looking at for 2020 and also what we have projected for 2021. Anticipating this strong earnings rebound through 2021, we're thinking that it's going to allow stocks to grow into these valuations in the long term. We see an S&P 500 fair value target range 3,850 to 3,900 at the end of 2021. This is just one of the targets that we use in our research. Other companies that we work with and use in our day-to-day have ending 4,200. Goldman Sachs has up at 4,300. And for reference, we just closed today right under 3,850. So overall, as we continue to work through vaccine distribution, really getting to the other side of the pandemic, allowing the economy to fully reopen, we do anticipate that corporate America will begin to show its improved earnings potential with an estimated S&P 500 earnings at $165 to end the year higher than we are today. As Justin mentioned, we have the 10-year Treasury yield here as well, remaining low between 1.25% and 1.75%. So in 2020, the S&P was able to fully recover its bear market decline in only 6 months. This can usually take years. After a strong rally such as this, it would be logical to think that returns going forward may not be as strong. But as we can see here, that's not always been the case. Historically, some of the worst economic conditions have been followed by some of the biggest rallies. Here we have 1970, 1974, 1987, 2002, and 2009. The blue portion of the graph is the S&P 500 market returns 1 year after a 30% or greater decline in stocks. And the orange on top is 2 years after the continued growth. So it's really showing that stocks tend to add gains and continue to perform well after the initial surge, which is kind of at the point that we're at now. We're coming up on 1 year of hitting market lows. So this is further supporting really the idea that we are entering the beginning of a new economic cycle, and we probably do have several years to run with positivity going forward. So here we have earnings poised for this sharp rebound. The S&P 500 earnings per share from 2019 through 2022. So in 2020, we ended just under $140 and are predicting around $165 for 2021, upwards of $190 for 2022. So it is somewhat easier to predict 2022, as we can hope that we've gotten completely through the pandemic. We're on the other side. And if we do believe in this potential rebound over the next few years, you can kind of take the idea that stocks really aren't all that expensive right now. We do anticipate a bumpy ride. There is going to be some pullbacks as we have been seeing the last week or so, and will continue to. But like I said, we believe that this cycle has years to run with the economic data and really getting through the pandemic, and believing that strong earnings are going to drive positive returns in the equity markets, which is going to continue to give us good buying opportunities sooner rather than later in the stock markets to be able to take advantage of the potential and this new cycle. So that is all we have today. Thank you for joining us this evening. There will be a survey to complete upon exiting the webinar. If you could please take a few minutes to do that, we would really appreciate your feedback. Thank you again for joining us this evening. Here's some disclosures for you all. We are branch advisors with Northwest Financial and Northwest Federal Credit Union, so we are available there as well, mostly virtual at this time. But if anyone was interested in having a conversation more in depth about your specific situation, that's what we're here for. So thank you for joining us, and that's all we have.